alongside me is Gary Jenkins. He's head of credit research at Evolution Securities. Gary, thank you for coming in.
Pleasure.
It does look like, well, we're just not getting the good news that hopefully, we were going to get. But how much does Moody's downgrade affect your strategy in terms of where you put your money in sovereign debt?
It doesn't really change it at all. It was totally expected. S&P had already beaten them to it. The only real difference it makes is there will be some investors who will be forced sellers of Greek debt on the back of this. But to be honest with you, the other thing that I would look at is the speed of the deterioration, because Greece has gone from A2 to BA1 in 55 days, and the average number of days that should take is 6,500.
All right. What does it tell us for where investors should put their money? Because we're also seeing concerns about possibly a bailout for Spain. They've rejected this accusation somewhat, but maybe the banks will need some kind of extra funding in Spain.
Well, the banks is where we're all looking now, because clearly the banks are just really struggling to raise any money in the markets. And this is an extraordinary situation, because if you came down from Mars, having been there for the last 4 years, you'd look at the major banks in Europe and say they're profitable and their Tier 1 capital ratios are very high. So what's the problem? But of course there are a lot of problems. There's asset quality problems. There's the amount of issuance that's going to come down the road from banks and governments. And there's regulatory changes. And all these are just sucking confidence out of the banking sector.
And it does seem that without the ECB, they possibly wouldn't even able to survive. Do you agree with that?
Well, yeah, because there's a very, very simple rule that you learn when you first start to learn how to analyse anything, and that is that cash is absolute king. And without liquidity, you go bust. If the banks weren't getting the liquidity from the ECB, then we'd have a real major market meltdown on our hands. So that actually means...
Gary, do we actually risk a meltdown? Is this something that's still a possibility?
You can't. The ECB has to keep providing finance. They have to keep providing liquidity, because the future of Europe is tied up with the banks and the sovereigns. You have to have a working banking system, so they have to keep providing finance. Until we get confidence back in the market, until we get on a more stable footing. But the problem is we have too much debt, we have too much issuance coming down the road, and therefore at some stage the ECB and the EU might have to look at drastic changes to how we're funding banks, because at the moment it's very much short term. That isn't going to help the overall economy. If they really want the economy to improve and banks to lend, they have to start lending to banks longer term.
So, Gary, given the situation, do you absolutely stay away from European bonds, or actually do you see some buying opportunities?
There may well be buying opportunities coming down the road for individual institutions, but to be perfectly honest, right now most people are all doing the same thing. They're looking at bonds, they're looking at treasuries, they're looking at gilts, and they're just keeping it as safe as they can possibly keep it until they see which way this is going to break.
Treasuries on the longer part of the curve?
Well, I think...
Or both?
Well, you can look at both, but I think most people are trying to keep their money as short as possible right now.
What about emerging markets?
Well, emerging markets are an interesting opportunity, but if you're facing a situation which is as serious as the one we're facing, then eventually all risk assets will be hurt.
All right, Gary, let's actually have a listen at one of our guests earlier.
We will send a joint letter to the Canadian Prime Minister Stephen Harper to call for increased regulation of international markets and to call for a tax on international financial transactions. And Germany and France will both support this project. And with this letter, Germany and France will also press for a global banking levy.
He wasn't one of our guests, actually. He was the president of France.
I recognise
Gary, regulation is a big concern going forward. How does that affect your investment strategy?
Well, from a couple of different viewpoints, really. First of all, I'm sure the regulators would like to be a lot harder with the banks than they have been so far. But they can't be hard until the banks are in a situation where they can actually take the pressure. The other thing is that we just don't know quite how that's going to pan out, because if it was me lending all the money, if I was the one giving all the liquidity, I'd want a bigger share of the profits. So at some stage you could well get political risks saying, actually, banks, you're making all this money off the back of us, not your shareholders anymore, so we want more of it. So higher taxes, stricter regulation. From a bondholder's point of view, that might not be a bad thing, but I'd certainly question whether you want to be an equity holder to an aggressive degree.